Well, good morning, guys. How are we doing today? Great. Are we? How'd you like the math of value creation? You're all over it, right? You're ready for it? We discussed all of it. Any issues, any questions at all?
For the free cash flow equation that uses G, the growth,
Uh-huh.
is that just different because we're estimating G?
Perfect. So think about this for a minute. If we have a free cash flow that is no plat plus depreciation minus change in net working capital minus net capital spending, then the change in net working capital and net capital spending, which is also a change, right? Because it's fixed assets from time 1 minus fixed assets from time 0 plus depreciation. So both of those variables represent a change from one period to the next, right? Well, they're the change in the invested capital that the firm is using to create no plat or its revenues, okay? That change in invested capital is a growth. So inherent in this equation is a growth, positive or negative, in the firm's invested capital. That then is echoed in that other equation for free cash flow. Which is free cash flow is equal to no plat times 1 minus G divided by ROIC. Well, here, return on invested capital is simply an interaction of no plat and invested capital, right? Because return on invested capital is no plat divided by invested capital. So this G and the invested capital here are reflected in this part of the equation here. And the depreciation if you disaggregate this, okay? So, Kira, you're exactly right. Here, we didn't assign a G, a growth rate. We observed it from this change and the change inherent in net capital spending. So we saw the growth rate. We didn't actually specify it, but we used the values that would have specified it had we chosen to do so. Here, we're assigning a G, okay? Here's the thing, though. I think, and we may have talked about this the other day, since this no plat and this no plat are the same thing, and the depreciation here is going to be inherent every place else as well, right? If that's the case then, and we know that return on invested capital is a function of invested capital and no plat, the interaction, then this G that we put here, if we reverse engineer this to find G, the G that we're finding is for this year's no plat and return on invested capital, which would be the same G that we have here if we reverse engineer or normalize on G using this free cash flow. So one of the reasons why we can't just say that that equation re-engineered to solve for G is our solution for a long-term G is because it's only indicative of the G that we find in this period for these variables. So it would be nice if we say, oh gosh, this is our solution. This gives us the long-term G. But it's reflective of a particular period of time, which may not be reflective of a long-term future. Remember that when we're assigning a G here, because we use this in the continuation part of the estimation equation, which you may not quite understand what that means yet, but you'll have a better glimpse of it today. That G is the long-run growth rate of the cash flow variable in the equation, or no plat in this case. The long run. And long run means perpetuity. So it's longer than we can count even. It's not designed to just tell us about this 1 year. It's supposed to tell us about forever. So when we assign a number here, it's not likely that it's the same number that we observed here in this one period. You almost wish you hadn't asked, don't you? And that is the question you were supposed to have coming out of this. The rest of this should have been very straightforward for you. Anything else?
So would you usually use the first one to estimate free cash flow today and then the other one to estimate it in the future?
Yeah, that's exactly right. So think about this. Remember the dividend growth or dividend yield equation from Finance 300? Can anybody articulate it for me? Did anyone pass Finance 300? Thank you. Okay. So there's an equation that says P0 is equal to D1 divided by R minus G. Now do you remember? Okay. And this P at time 0, or now, is the price of common stock. Because common stock is the only stock that necessarily, or that we're thinking about in this respect that has a changing or changeable dividend. Okay? And this D is a dividend. This G is the growth rate of this dividend in perpetuity, and this R is the discount rate, so that we've created a present value equation. Now you might recall that this is equal to the sum of some D1s divided by 1 plus R to the T, where these D's are growing at a constant rate every year in perpetuity. That's what this equation is designed to capture, okay? So it really is an algebraic simplification of an infinite term. And we need the simplification because we can't sum an infinite series of numbers. Every time we think we're done, we're not done, right? So it's a problem for us. Well, think about this in slightly different terms. I might say the value of something at time 0. And P, the price of the common stock, is simply the value of the common stock, right? And rather than be very specific and say we're only going to think about the dividend as the cash flow variable, let's think about free cash flow as the cash flow variable. Because it's more encompassing, right? And it tells us about the whole firm, not just something about the common stock. In which case, we can now use R minus G, and R is simply a generalized variable for some discount rate. Depending upon how you're looking at this, it might be your required rate of return as an investor. It might be inflation, the rate at which money loses value. It might be a hurdle rate. You have borrowed money at 7%, you're investing it, so you've got to do at least 7% or you're in trouble, right? Because you're not even earning your interest rate if you aren't earning at least 7%. Or maybe it's the weighted average cost of capital, which we're going to look at again in detail today, and again, it should be one of the last things you dealt with in Finance 300. It could be the weighted average cost of capital, which is the firm's opportunity cost of money. So it's just some discount rate, and there are a lot of versions of discount rates, and they're going to be different based upon the scenario. So this free cash flow and this dividend have a lot in common. They're the next thing we expect to get. But in this equation, all we're getting in the cash flow is the dividend. So it only gives us something about the price of the common stock. We're not going to look at simply the price or value of stocks. When you get into Finance 305, which some of you might be taking concurrently right now, that's more about stocks and stock markets. This valuation structure that we'll deal with, for the whole term, production value, is the value of the whole company, including but not limited to its common stock. And what we're estimating is enterprise value. So it's going to be the market cap of the common, plus the market cap of the preferred, plus the market value of the debt, minus cash. I'm going to offer that in way of review. What other questions might you have? Please, Cole.
So when we have problem sets, when we have to utilize the second free cash flow, is there kind of a G that we should use, or is it kind of dependent upon some context?
Good question. So you will almost always be given some information that lets you think about what G should be, okay? That information might be, we expect the long-run growth rate of the company's cash flow to equal the expected rate of inflation at 2.5%. We believe the company has outsized long-run growth rates expected at 5 or 6%. I mean, something like that. Or I might say that we believe that the long-run growth rate of the company's cash flow will equal the current growth rate of the company's cash flow from periods 1 and 0. You'll be given some piece of information. I think there's only one of these in which you have to synthesize or guess at one. But that's towards the end of the term, in which I'm asking you by then to be able to look at these scenarios without complete information, but have developed the intuition to be able to think, okay, I don't have that data. Given the rest of the data I have, what is a reasonable value for that data point? So you have to make an assumption, and then you have to state why you made the assumption. So you'll see that we get there, okay? In fact, by the time we're done here, there's a number of assumptions that we have to think about making, but I should have given you by then the tools or the mindset to be able to credibly make those assumptions. It's a good question. Anything else? Yeah, Garrett.
How do we know which invested capital equation to use and why in this scenario?
Good question. So let me first.
I know that the numbers were the same.
Yes, but I'm gonna talk about this before I answer that because it's in the same vein. When do you use this red equation for free cash flow? I've only said this like 7 times in the last week or so.
Current revenue.
Well, it's current, and let me just always, unless there's a reason to use this second one. And this is the key value driver form of free cash flow. And in the key value driver equation, we use this form instead of this free cash flow, okay? In the continuation term only.
So the reason to use that one would be you're given a growth rate or have like a pretty reasonable.
No, not even that, Garrett. The reason is because you're instructed to use the key value driver equation or the key value driver model, in which case this is the form of free cash flow you use in the continuation period only, not in what I'll just define later on as the explicit period, okay? We use it in the continuation period only. We will talk at the very end of the term about valuation multiples, and we won't get terribly deep into them. That becomes the fodder for Finance 409 and some other experiences that you might have. But you'll find that this equation for free cash flow coming out of the valuation multiple, we most often can think about it algebraically, and it harkens back to this key driver form of free cash flow. Okay, but we'll get there. But really, the answer to the question is use this always unless you've got a reason to use this. Which reason should be that you are doing the key value driver model and you're operating in the continuation term. Okay? Now to answer your question about invested capital. Our 2 forms of invested capital. Invested capital is equal to fixed assets plus net working capital, or invested capital is equal to total debt plus total equity. And total debt is the long-term capital debt. It doesn't include liquid asset, or rather current liabilities. Okay? This is called the operations approach. This is called the finance approach. And as you said a minute ago, they give you the exact same number, assuming you're assessing those inputs for the entirety of the company, and assuming the balance sheet balances. If the balance sheet doesn't balance, you're screwed, okay? But then you ought to be starting over somewhere anyway. That said, in this one, which is the one I virtually always use, okay, just by default, since they do give me the same number either way, if I'm looking at the whole company. But I use this one because very often I'm not looking at the whole company. I'm only looking at part of the company. I'm trying to assess the European operations, which are centered out of Paris and Luxembourg. And I can define, because of those operations, the fixed assets that are held in them, the net working capital on the balance sheets from those parts of the companies. And so I can look at part of the company and I can see it separately. Here, I don't know what part of the stock, well, we issued stock in this company 30 years ago and raised some money. I don't know what part of that exists in the European operations and what part of it exists in Asia and what part of it exists in South America. I just can't tell anymore. So that's the difference. So I always use the operations approach, and unless I'm instructed otherwise in a problem set, which every once in a while you might, okay? But I always use the operations approach because it lets me see separable parts of the company that the financing approach simply does not. There was a hand over here, I think, or Zach.
So in financial statements, is that something they break up? Like, these are our fixed assets for X location?
Yes. Now, if you look at the financial statements of a firm, say in FactSet, or you look at their K1, which is something that they produce as they're doing regulatory reporting, and it's a multinational concern, that income statement and balance sheet may not have broken out the detail. It's going to be the aggregate of the whole company. But I guarantee you that in that company, somebody put together a balance sheet and an income statement for every one of the substantial parts of the company.
So I guess I'm wondering, how would you apply that? Is that just something you would?
Okay, good
ask
question.
about?
So think about this. We are looking at how we would value an asset, and we're saying that asset is something as complex as a firm, right? Well, if we're getting to the point of needing to value one of these, then we probably are close enough to it, certainly if we're trying to value a part of it. We're close enough to it and its decision makers, managers, accountants, etc., that we have access to that. Now, if you're just trying to value it because you're trying to look at a company in the open markets, and you're trying to see if the price it's currently trading at has some relationship to the price you would assign it with a valuation model, well, then you're looking at the whole company, so you don't even have to look at parsing this out. But if you think about parsing it out, you're probably doing so in concert with or with the express cooperation of the company's managers, etc.
So it's more internal.
Mm-hmm. Yeah, yeah. And if Brigham's got a company, I want to buy part of it. If he doesn't want me to buy part of it or think about buying part of it, then he's not going to show it to me, in which case I'm going to buy the whole thing and take him out of hospital, right? Would that I could. But if he's interested in selling that part, he's also going to show me his audited financial statements in all the minutiae I'm looking at, because he wants my check to clear the bank with a lot of zeros. Okay? Fair enough? All right. So let's switch gears. I want to talk about economic profit and opportunity cost. Thanks. Economic profit and opportunity cost. So I want you to think back to your micro and macro classes. Have any of you not taken your elementary micro and macro classes yet? Good, that's what I thought. Okay, tell me what economic profit is. We haven't discussed this yet, have we? Okay, I didn't think so. Tell me about economic profit. Cole?
If I remember right, economic profit would be the one where, actually no, wouldn't accounting profit be where you're simply just making a profit beyond zero? Economic profit would be factoring in some opportunity costs.
That is exactly what it is. So we know that profit in the accounting sense is net income. And we know that net income is all the revenues minus all the expenses, including interest, tax, everything. And that's what the company has to be able to distribute out to shareholders in the way of dividends or reinvest in itself in the way of retained earnings. Okay, that's net income. So here I am Sherry's accountant. And I've come to Sherry and said, Sherry, it's a great first year, Sherry. this first year of your new business, you profited, you had net income equaling $100,000. I am so proud of you I just can't believe how successful you were. Thank you for leading the company. Sherry, on the other hand, puts her head in her hands and starts to weep uncontrollably, and is not happy tears. She's about to kill herself. Why? How could that possibly be? First year, she profited 100 grand. I mean, in a new business, that's not good. That's freaking phenomenal.
Because her economic profit is 0 or it might even be negative.
But, yeah, but what's that? Who cares?
Well, it means that she could have used that money and invested it in a different way and had made more money.
Okay.
Yeah, that's what it was.
Same thing. He stole your thunder. So what I'm not thinking about, I knew this, but I wasn't thinking about it. Sherry invested $5 million in this business, which is not necessarily unusual, right? And Sherry's annual income prior to stepping aside and founding this business, which, by the way, this $100,000 has not had a deduction for any salary for Sherry, because how many business owners, entrepreneurs do you know take a salary in the first year? Precious few, okay? So even then, we're thinking, well, gosh, this means you could have a salary of $100,000, still broken even. Sherry, that's still pretty good news for a first-year business venture, right? But Sherry knows that in the open market, she has been paid by other firms $200,000 a year. So that's her opportunity cost of her time. By the way, this $5 million she earned because she has had an earning of a couple $100,000 a year for some time now. So her realistic opportunity cost of her time can be equated to that which some other firm has paid her, or which she's been able to pay herself from her own firm. It's not just some hypothetical, I think I'm worth something, okay? The opportunity cost of her investment capital is what she could certainly get for it elsewhere. Well, let's suppose that all Sherry did was put this into a bank in a CD at 2%. If she did, then that 2% would have given her, I think, $100,000 all by itself, right? So if you look at her net income minus the $100,000 for her opportunity cost of capital, minus the $200,000, which is the opportunity cost of her time, she's in the hole 200 grand. Which in this case means that her capital lay fallow and her time would have been as well spent watching soap operas, eating bonbons. Or the bonbons would have cost her something. Please, Zach.
Would you not count the 5 million as is it just a sunk cost at that point, or would you not count that when you're calculating your economic profit?
I am counting it because but I'm counting what it produces, okay? The opportunity cost of it. So she could have had this invested in her business, which she did, or she could have had it invested in just a CD. No risks, no time, no fear, and it would have given her $100,000, right? She invested it in this dog, which also gave her $100,000 because it consumed all of her time and paid her nothing. Now, I say this dog. I mean, what we're really saying is that she had a negative economic profit, because economic profit is equal to accounting profit minus opportunity costs of the investor's time and capital. Which we don't see in the tax schedules. Accountants don't account for it. It's not a number we see on an income statement. It doesn't affect the balance sheet. It's not there. How come? Please, Cole.
The variability of the opportunity cost, essentially.
I don't think that's why, although opportunity cost is variable. But I don't think that's why. Zach?
Is it because it's kind of hypothetical? Like,
Yes, that's part of it, but that's part of your thought of variability, right? Right.
Like it doesn't exactly affect the firm, it's more of a personal thing. The way I see it is because the firm doesn't really care about your opportunity cost. At the end of the day, it's more the person's more mad that like, oh, I could have made this much more. I don't know if you get where I'm coming from.
Okay. I think there's some truth to that, but that's still not the express reason why. Tell me about the language of accountants and accountancy and what that language is designed to serve and where it comes from. Do you remember the, Mikkel?
Investors, I guess?
Not even investors, as it turns out.
Balance sheet and income statement?
Yeah, so apparently we're playing guess what's on my mind, and I'm sorry, that's not a game that I purposely make you play. The language of accountancy exists because of GAAP principles, which are governed by FASB. And what does GAAP mean?
General accepted accounting principles.
Yes, generally accepted accounting principles, which are dictated by FASB, the Financial Accounting and Standards Board. And GAAP and FASB rules give us the language and the methods that we as business owners or business participants can use to communicate how our business is doing to the public, right? And so anytime you're producing a balance sheet, income statement, anything like a statement for your business has to follow GAAP, which is informed by FASB. Does that mean, because you follow GAAP, that it is now worthy of use for the IRS? Or is there another set of refined principles on top of GAAP that the IRS uses? Do you know? There is. For example, GAAP would allow you to use straight line depreciation, double declining balance depreciation, accelerated cost recovery system depreciation, modified accelerated cost recovery system depreciation. GAAP would allow you to look at an asset and say, I think that that asset should have a lifespan of 10 years. I'm going to use a straight line on it. Okay? Whereas if you're accounting for taxes and you are now having to use GAAP modified for the IRS purposes, you are required to use a specific type of depreciation for each specific asset. You don't have the flexibility. So accounting language, which is largely what we hear about and see, right? Accounting language is first influenced by GAAP and FASB, but then it's also influenced and it operates the dictates of the IRS. The IRS doesn't tax us on the opportunity costs or rewards of our capitals, human or physical or financial or technological. It only taxes us on the rewards that we actually got. Okay? That's why net income doesn't include it, because net income is a slave to GAAP and to IRS standards. Okay? Economists, though, realize there's more to life because something was expended that's not being recognized on the balance sheet. Time and capital. Okay? So that's opportunity cost. Any questions about that? Okay. Let's now think about opportunity cost in a different vein. I will tell you that economic profit, not opportunity cost, excuse me, is also equal to invested capital, which we know that there's going to be some interaction of invested capital because invested capital is the capital that's being invested here, right? Okay. Times return on invested capital. So that which we get from the business is our invested capital times our return on that capital. That makes sense, right? Minus the weighted average cost of that capital. So if I have a return on capital minus the cost of capital, what I have left is that which the capital gave me over and above the cost of it, right? If I then interact this term, multiply it by the invested capital, it gives me my economic profit. Now remember that I've said that WACC is one of the various forms of R, okay? Weighted average cost of capital is the opportunity cost of capital as it's been invested in the firm. Or when the firm is thinking about their cost of capital from a market perspective, an opportunity cost perspective, it thinks about its weighted average cost of its capital elements. Well, what are its capital elements? Common stock, preferred stock, and long-term debt, right? Those are the capital components that we're going to think about. How many of you recall the WACC equation from Finance 300? I'm not going to ask you to give it to me, just how many of you recall? Thank you. You were afraid for a minute I was going to make you put it on the board, right? So I lied. No, I didn't. Okay. So I want you to think about this. E stands for the market value of the firm's common stock. E is the market value of the firm's common stock. P is the market value of the firm's preferred stock. And D is the market value of the firm's long-term debt. Okay? E plus P plus D then should be the market value of the firm's capital components, because those are the firm's three capital components. Now we're going to say that that's V. Okay? Such that E divided by V is the percentage of the firm's capital that's represented by its common stock. Right with that? And P divided by V is the percentage of the firm's capital represented by its preferred stock. And D divided by V is the percentage of the firm's capital represented by its long-term debt. Now I keep saying market value because I'm trying to beat this into your minds. But as you look at some of the next two problem sets, including the continuation on the math of value creation, I think I ask you at first to use the book value of those. And then I think I ask you to use the market value of those components. You've got the information to do so, I think. And that then lets you see some of the differences, because book values and market values may be dramatically different, right? How much credence do I give book values, or how much do I care about book values? Precious little, right, Zach? They're not useless, but I can only use them as a historical artifact. They tell me something, but they don't tell me an awful lot about right now. And I'm probably mostly interested in right now. In fact, I'm exclusively interested in right now when it comes to thinking about valuation, because it's the value now, okay? Not in the past. I'm not worried about the value in the past, okay? So I'm building an equation for weighted average cost of capital here. The weighted average cost of a firm's capital obviously includes its capital elements by their weights. Okay? I'm going to interact E divided by V with RE. And RE is the opportunity cost of the firm's equity capital housed in its common stock. So in this equation, E stands for common stock. Okay? I don't know why, by the way. I don't know why it wasn't C, but I didn't make it up. Somebody else did. And we're going to take this weight times this cost plus this weight times the opportunity cost of the firm's preferred stock plus this weight representing the firm's debt times the opportunity cost of debt capital, RD. So RE, RP, and RD are the opportunity costs of those elements in the firm's capital structure. Okay? Well, this one, RD, and I'm going to define each of these in a few minutes and give you even a hierarchy of which you should use when and where, okay? Because there are numerous definitions for these. Remember, back to our first discussion, the rules of finance are all set in stone, except for when they're not, okay? And I've been starting to give you inklings to that because some forms of free cash flow are different than other forms of free cash flow, right? And some forms of RE, RP, RD are different than other forms of RE, RP, RD. What you need to do is always choose the form that matches what you're trying to accomplish or that gives you the best information available. Sometimes you don't have the best information available and you use the next best because it's all you can do, okay? Well, if we have a cost of debt, we think about that generally as an interest rate, right? Or an interest expense. What is unique about an interest expense that does not apply to dividends paid to preferred shareholders or dividends paid to common shareholders from the standpoint of the firm? What benefit does the firm get by paying interest that it doesn't get by paying dividends? Cole?
Tax.
We have tax relief, right? Because that interest expense is tax deductible. So we reduce our taxable income by the dollar amount of the interest expense, and so our tax liability is lower, and because of that, we then have to multiply that part of the equation by 1 minus the tax rate on taxable income. Okay? So what we've then given ourselves now is an after-tax weighted average cost of capital. Okay? And if the firm has no tax rate, or if we're not interested in taxes, we don't have to apply that last part. I just don't know when we don't have tax rates and when we're not interested in taxes. I think most of us are vitally interested. Okay? What questions? 'Cause I see you starting to commit.
I'm looking at the sheet you gave us.
Yep.
And on the T, it's 1 minus T.
TC.
Yeah, what would be the difference?
Corporate tax rate.
Okay,
It's a subscript intended to be generalized, meaning the same thing.
okay.
Yep. Garrett, I think you got a comment or question?
No, just
No.
clarification.
Okay. Well, if you look at the finance textbooks, like the one you use for Finance 300, you'll see that the weighted average cost of capital equation suggests we use the market value of the firm's equity, common stock, market value of the firm's preferred, and the book value of the firm's debt. Okay? To me, that is not a market-based true opportunity cost because it's using this historical artifact. All right? And I don't know of any finance textbook that walks you through the WACC equation and tells you to use market values for all of these. I posted for you online or in Canvas a couple of days ago a video from a guy at Reisner University that was talking about the market value of bond equation. And he goes on and has a link to some other little YouTubes he's got to help you work through WACC. And it's the first time I've ever seen anybody from a university start to talk about the market value of a firm's capital debt when it calculates WACC. Most companies, most estimators don't bother doing that. So the question is why? Well, if we have common stock, and if it's exposed to the market, we easily know its market value, right? Look at go to Google.anything, and you're going to find it, right? Same thing with preferred. It's hard to find the market value of a firm's debt. Partially because here we have Alex, and Alex is in charge of this large multi-state conglomerate, and you've issued bonds 7 times over the last 30 years. And all 7 of those bond offerings are still outstanding. And they all have different maturity dates because they were issued over the last 30 years. And they all have different coupon rates because they were issued over the last 30 years, right? Well, how do I calculate the market value of all of that debt? I've got to go in and I've got to look at every one of those debt offerings. I have to come up with a market value of debt for each one of them, right? Which means I have to think about what the current yield would be on that kind of debt in the market today, were it to be issued today for that company. Which means I have to also bring into it the leverage ratio of that company and the credit capacity of that company and the credit worthiness of the company. Shoot me now, right? It's extraordinarily complex. Plus, if that debt happens to be callable, so the firm can go back and buy it back at its face value at a date and time, that affects the equation as well. It's kind of like when a firm has numerous preferred stock offerings, which many firms that have preferred stock have numerous preferred stock offerings. They're hard to deal with, okay? So most valuators don't even bother. But if you don't do it, you're leaving out possibly an incredibly rich part of the equation, which may make a big difference in the outcome. Okay? Does that make sense? Okay. So let's, so this is just a WACC equation. Weighted average cost of capital. I said just, and Garrett wants to reach out and grab me 5 and 10. Okay, it's just the WACC equation, brother, I promise. You're gonna get used to it. It's actually a lot simpler than you think it is, and I'm about to make it a lot more complex. Fair enough? Okay. A little aggressive there. Okay. Don't be laughing at me here.
No,
My friend Zach is taller than I.
I didn't say anything.
Okay, let's talk about RE, RP, and RD. And I want to talk about them in terms of the best, most accurate estimator for them, one that is okay, and one that is just barely acceptable. Recognizing that whenever you are responsible to calculate RE, RP, or RD, you should always use the best, assuming you have the information that leads you to the best. And if you don't, you use that which is second best, or that which is next best, which is barely acceptable. Okay? I'm going to start with RD, because it's kind of the easiest. All right? Since we're talking about opportunity costs, we're talking about something synonymous with opportunity benefits, right? So think about this. I've used R, or the convention in finance uses R for each of these, but R, I don't know how I get cost and R at the same time, right? And recognize this is capital R, not lowercase r. Lowercase r is a discount rate. Okay? This is a capital R, so it's something calculated expressly. And I keep talking about these as the cost of. Well, I could just as easily say it was the return on. Alex, how am I able to do that? Why can I say cost of and return on and have them mean the exact same thing? Any idea?
I'm not sure.
Okay. So you were silly enough to loan me $1,000. I don't know what you're thinking, by the way, okay? You loan me $1,000 and you charge me a 10% interest rate. What is my cost on that loan?
$1,000.
Well, no, the loan was $1,000. What's my cost? It's the interest rate, right? It's the 10%. What is your return on that loan? The 10%. It's the same thing. Looking at it from two different perspectives, okay? So cost and return, or cost and benefit, should be the exact same thing, just from different vantage points, okay? So RD. I'm going to tell you that for RD, the very best is to use the current yield, or what that kind of investment would either cost or return if it were to be put in place today. When I say that kind of investment, when we're talking about debt for the company, I've got to think about the term of the debt, right? 10 years, 20 years, 30 years, because that's going to affect its cost and return. I've got to think about the credit capacity of the company. I've got to think about the markets that we're in. I have to think about all kinds of stuff. But if I've got enough information, I should be able to identify Zach's company's going out to the market for $10 million in 20-year bonds. He's got a AAA Standard & Poor's credit rating, and it's going to represent 10% of his company capital structure. That's going to receive the best rate the market has to offer for a 20-year issue, right? So I should be able to find that number. So it's current yield. The next best, if I don't have current yield available to me, would be the interest his company pays at time one, so this period of time we're looking at, divided by the value of the debt at time zero. And I'm going to say in this, excuse me, I meant to make those blue, because this is the okay. I apologize, let me redo that. The interest paid at time one divided by the debt the market value of the debt at time 0. So what's paying in this coming period versus against what the balance was in the last period. Why do I have that temporal offset? Why am I not looking at the interest paid today and the debt balance today? Zach?
Because it wouldn't give you an accurate percent, because that interest is based on what the principal of the loan was.
What the principal was, right? We don't pay interest on something today, we pay interest on what has happened in our most recent period, right? That's why, okay? So that temporal offset is natural because of the kind of instrument we're looking at, that's commonly used that way. If we don't have that information, and sometimes we don't, lots of times we don't for this. In Zach's situation, what if I just don't know what his creditworthiness is? I know everything else, I just don't know the creditworthiness of the company. I can't get a good current yield, then can I, right? So I might have to default to looking at the interest that he's contracted to pay over the last year and compare that to the value, market value of the debt. And if I don't have those, because market value of the debt requires some information that might be elusive to me, then I might have to look at the interest for this coming period divided by the debt balance, the book value of the debt balance. So in black I have book value, in blue I have market value. Zach?
That's what I was.
Yep, yep. So market value, in fact, let me just do this. Market value and book value. Okay? Best, better, okay. Any questions about that? Yes, Zach?
So with the okay one, what's an example of how we would find the market value of that debt?
Sometimes it's given to us. Okay. So let's say it's a company that has publicly traded or publicly available bonds. So we ought to be able to determine the market value of its debt because it's publicly available, they're traded in the market.
So with the bond that we're looking at right now, we would just use that as a representation of the bond that was purchased or sold in the past?
Well, yes, yes. Let me give you kind of a list for a moment. It'll help you a little bit here. And I don't know that we've gone through this yet. So on a company's balance sheet, its capital debt largely includes bonds, bank loans, mortgages, credit lines, or other long-term debt instruments we can lump into those categories, like a note payable, long-term note payable. Well, it may not be from a bank, but it might as well be. It's going to have the same rules. It's going to have an interest rate, a time period. It's going to have a contract, the whole thing, right? Okay, so let's think about each one of those for a moment and briefly consider how we identify the market value of each of those elements. Do any of you know an equation that lets you identify the market value of a bond? Finance 300. Oh, you're killing me.
Just no plug and
Say what?
Just no plug and calculators.
Yeah. Who did you take Finance 300 from?
Lauren.
Really? And you only know that? Oh, we'll have a conversation. Okay.
Really?
Yes. C times 1 minus 1 divided by 1 plus YTM to the exponent of n divided by YTM plus F divided by 1 plus YTM to the value of n.
Rick, I've never seen that in my life. I don't think I've...
Well, you will. And you will see it in the daytime, you will see it in your dreams, you will see it in your darkest and most elated moments.
But we learned that in Finance 300.
Pardon me?
We're supposed to learn that in Finance 300.
Finance 300.
Oh, wow.
Oh, yeah. Yeah.
This is weird.
I learned
Okay.
Okay, we'll solve that blaring inadequacy in your lives in the next couple of weeks, okay?
We learned that, just not explicitly through that equation, just through a calculator.
Right, by the time we're done next week, I will have not only beat that into your cerebral cortex, but help you understand how to manipulate it manually and with the time value functions on your calculator, okay? Which apparently you guys already know. But if we have these pieces of information, the coupon rate of the company which begets its coupon payment, how many years, or periods rather, it has left to maturity, and what its current yield to maturity is divided by the number of periods, and what its face value is, which is virtually $1,000 for all bonds, not literally, but virtually, then we can find the market value of a bond. Okay? Similarly, if we have that same information about a bank loan or a note payable, then we can find its market value as well, right? We can, I promise. If we don't have that information, then maybe we would have to take some bank loans and look at the book value as though it was their market value. And here's why it's credible to do that. So Mikkel, you owe my bank, your corporation owns my bank $200,000 from a loan you took out, an interest-only loan you took out 3 years ago. It's not due for another year still, okay? But you owe it, right? $200,000. When interest rates, when you took out that loan, interest rates were at 10%. Today they've come down a little bit, they're at 8%, let's say. So we know that typically when interest rates fall on a debt instrument, the market value of the debt instrument rises. We're nodding our heads?
Yeah.
Why do we know that? Kara, why do we know that? What's the inference?
Just that, well, the value is going up because
Well, why?
people are gonna get a higher return.
No, I said the current yields are a lesser return. Think,
The value goes up because it's locked in at the old percentage in the
Yes.
sense, and so technically against the market, you're getting a better return on your money, and so you can.
I was getting a better return on money than I could get today in my little story, right?
So the value goes up on the bond because you
Yeah,
keep that.
so think about it this way. Let's assume that I have a bond at 10% when it was issued 7 years ago, and today bonds are at 6%. That bond at 10% 7 years ago is paying me $100 a year in interest, right? Which has a value to me. If I were to put that same $1,000 into a bond today, it would give me 7% or $70. Which is more valuable to me? Something that's going to give me $100 every period or $70 every period? Well, the 100, right? That doesn't take a rocket science. That's why when interest rates fall, debt values rise, because it became more valuable. It's continuing to pay that $100 payment even though it's in a 7% world, because that payment probably is based upon a contract that's locked down. Zach?
Does the number of years left in the bond factor into?
It does. That N in the equation is the number of years to maturity times the periods per year. So absolutely it does.
So, well, okay.
Yet, I think you'll be satisfied with the answer yes as we continue on, okay? So now back to Mikkel owing me 200 grand. I didn't forget about that, as it turns out. He comes to me, remember this was issued at 10% and now it's at 8%, right? So the market value of that has risen and it's not due yet. He comes to me and gives me $200,000 in a cashier's check and says, Rick, I'm here to pay off my loan in full. Am I likely to accept that $200,000 as payment in full for the loan? He's been current on all of his interest payments. He's not in arrears at all. Am I likely to accept it? The contract was for 200 grand, right, Mikkel?
Well, if you can get more than 10% of the market, you would accept it, right? 'Cause then you can
Maybe.
invest
Maybe I'd like to or not. But if the contract says $200,000 and you come in with $200,000, the contract says what the contract says. Gary?
You want those future interest payments?
Well, yeah, I want the future interest payments, but if I set up a contract that put me at risk of him paying it off early, then I set it up,
and
okay?
take the money.
Yeah, I take the money. So my point is, if we entered into that agreement, you'd expect to be able to come into the bank on any given day, pay off the loan based upon its remaining balance. Because our contract didn't say We were marking it to market values. So you would only expect to give me $200,000. If I didn't accept the $200,000, I'd say, fine, I'll take your money, but you still owe me some money. Your next call would be to your lawyer, right? Because you know that some level of screwing is taking place now. Okay. On the other side of that, what if he took out the loan at 8% and now it's a 10% environment? He comes in, and if it's a market value that we're thinking about, because he certainly is a market-oriented guy, he's thinking, okay, this is no longer a $200,000 loan. This loan only has a market value of something less than $200,000, right? If interest rates have gone up. And he offers to pay me $150,000 for it, which is what he thinks the market value is. And I look at him and say, fine, I'll take your $200,000, but you still owe me 50 grand, right? Because that is how most bank loan contracts work, we might simply take the book value or remaining balance of the loan as its market value, because it probably is what he could pay it off for, or what I'd expect from it. Fair enough? But Kira knows that the $200,000 loan is still on the books. And she knows that it may not be Mickle that pays it off. She has a bank holding company, and she's going to buy the debt that my bank owns. So she comes into my bank, and she pays me a dollar amount for the loan Mickle has taken out. So she's buying my debt. You'll hear about this kind of thing in the markets. She gets the covenants and contractual elements of the contract between us. She gets the 10%. Given that current interest rates are only in a 7% environment, she's going to pay more than $200,000 to get it. So we can credibly think of the market value as being either the book value if we don't know market value components, or the market value if we do know those components, because it's plausible that either might be used depending upon who pays off the loan.
Kind of more of a question just about like real life, with the sense of companies having a lot of bonds or debt out there for people like paying them back, is it common for that to be sold a lot, those contractual rights and stuff?
Well, certainly if they're bonds in the open markets, they're traded every day, every moment, right?
I guess loan debt, though, like...
Even that is relatively common.
Okay.
So, and it's, they're repackaged. You've heard about this with respect to mortgages, right? You borrow a mortgage, take out a mortgage from company XYZ, it gets repackaged into some bond or loan portfolio, and then you buy some part of it in your pension fund. Okay, so that's common as well. But it's also relatively common just for banks to sell excess debt, or debt that they don't want to keep on their balance sheet anymore. Okay, for example, I have a former associate who for many years was a good friend, but got himself into some serious financial trouble, and a local bank had quite a bit of his paper, or he borrowed quite a bit of money from the local bank, and they were about to put the hammer down on him. They were going to foreclose on him and dramatically affect his lifestyle. But they knew, because of some of the relationship that we had, because I had dealings with the bank for a number of years as well, they knew of that relationship, and so the local manager of the bank came to me and said, look, we're about to do this, and would you like to buy his debt? And so I bought his debt. I didn't pay as much as the book value of it, because we were discounting it for its now increased risk environment. There was a reason they were getting ready to bring the hammer down on it, right? So I bought it for, frankly, much less than half of its face value. And under the premise that if he paid off, I was in good shape. If he didn't pay the whole thing off, I was still in good shape. So that is not uncommon. Maybe less common for it to be an individual in a bank that does that, but businesses to businesses all the time. But not all businesses, okay? So bond and a bank loan, you might use the exact same elements if you have them to come to their market value. What's the market value of a mortgage? Any mortgage?
Maybe whatever is left on it.
Well, we might think of it as the remaining balance, and I think that you pretty much have to do that. We have a nice, neat little formula for the market value of an instrument that is interest only with a constant rate for a specified period of time and a known payment schedule. That's the bond value equation, right? for which there's no underlying collateral that is changing in value, okay? Because the bond and the bank loan is the full, is guaranteed by the full faith and credit of the company that borrowed the money, or the entity that borrowed the money. But if you own a piece of real estate and you take out a mortgage, the real estate underlies the mortgage as the collateral. And we've learned that real estate goes up and down in value, right? So here, Sherry has borrowed $500,000 from my bank. She borrowed it on a $700,000 residence that she purchased. She put $200,000 down. I gave her the money. Forget what the interest rate was. It doesn't make any difference in this case. But interest rates change. Market conditions change. Real estate values change. So apparently the interest rate went up in the market. Real estate values are now headed south. Okay? Sherry walks in to pay this off. She doesn't pay what we might think of as a market value because of changing interest rates. She pays the remaining balance on the loan. Except for, in this case, she owes $500,000, but Sherry, I'm sorry to be the one to tell you, but that $700,000 house you bought is now worth $400,000. I'm sorry, but it happens. In fact, we know it happens. We lived through it. You guys, yeah, you were all born well before 2006. Okay. You guys lived through it. I had to think about it for a minute.
12 years older.
I know. Hey, we're now dealing with students that were born after 9/11. We have students coming into our college that were born after the World Trade Center bombs. So I have to kind of think about dates for a second. So sorry, Sherry, but it's only worth $400,000 today. And you come in and say, look, I just sold the property for $400,000. Here's the $400,000. What do I think?
I'm not going to take it.
Pardon?
You're not going to take my
I
money.
am going to take your money. I am going to take your money.
So I still owe you.
Yeah, I'm going to say you still owe me $100,000, and depending upon the state in which you live, you might say, yes, I know I technically do, but you don't have the ability to come back after me for it. Because in many states, most states, you can only go after the collateral, not the borrower. Okay? Or if you do go after the borrower can just file some forms in a federal court, and that's done. And you don't have to declare bankruptcy. Okay? So it's very complex to know what the value of a mortgage is, right? You got to think about these interest rate environments, and you got to think about the value of the underlying collateral. So we're always going to take a mortgage's book value, its remaining balance, as its market value. What is it about this equation that sets up a different value than the original value for these bonds? And I don't care if it's the equation or if it's using the financial functions of the HP calculator. What sets up the changing value? No, it's the changing interest rate. Interest rates go up, values go down. Interest rates go down, values go up. So if the interest rate is unchanged, or if the interest rate that you're paying on that loan today is the same thing as the current rate on that type of loan today, then the loan would not have changed in value, right? Tell me about credit lines. What are some of the tenets of most credit lines for companies? Do any of you know? So Mason, you come to my bank. By the way, it's my bank. I've always wanted to own a bank. It's been one of my unrealistic dreams, okay? It's kind of my bucket listy kind of thing I'll probably never realize. And it's probably worth you knowing why I want to own a bank. I think it's a license to steal and be respected in the community. Right? Okay? I think. Anyway, so you come to my bank, you take out $1 million credit line for Mason Enterprises. Well, it's a $12 billion company. That's a rounding error, okay? I only said that because you were impressed with your ability to take out $1 million. Just because you opened up $1 million credit line, do you now owe my bank $1 million?
No,
How come?
because I haven't used any of it yet. Like, it's there, I can borrow it, but what I
Exactly.
haven't borrowed yet is
Yeah,
what I have to pay back.
that's exactly right. It's almost certainly a long-term obligation. Most credit lines are 10-year obligations, which are renegotiated and or renewed typically at the end of the term, assuming the financial worthiness of the entity has remained intact or improved. Okay? And one of the other common tenets of a credit line is they're almost all adjustable rate. So the rate you're paying on that money today is the current yield on that type of loan today. Why? Because you didn't take out the money when you opened up the credit line. You take it out or pay it back any given day during that 10 years. Constant exchange. So the current yield on that type of debt and the rate that you are paying in interest are the same number. Because of that, what do we think about what's happening to the market value compared to the book value? Doesn't change, right? Because the bond value equation, even if you used it, would come up with the same number as the book value or remaining balance. And it's important to know that that $1 million credit line, unless he uses part of it, shows up on his balance sheet at 0. It only shows up with a number once he borrows, actually uses some of the money. It's kind of like a credit card with different rules. Okay? So these are the 4 most common types of capital debt that we're going to find. And we can put virtually all other types of capital debt into these categories. We're going to always value this one with the bond value equation. If we have the information, we'll value bank loans with bond value equation. We will always take mortgages at the market or at the remaining balance, so the book value, and we'll always take credit lines at the book value. And we will call all of that market value because the book value on these is their market value as far as we're concerned. Fair enough? Okay. Let's change our gears and talk about RP for a minute. So the return on preferred, or the cost of preferred. Well, we're going to take the dividend paid on the preferred divided by the market value of the preferred at the same moment in time. We're not going to have the temporal offset that we used here. Same moment in time. Because preferred stocks pay their dividend to whoever owns them when the dividend is declared, not who owned them in the past. So it's a different set of rules than it is for debt. Okay? And here the red is market value. Next best is the dividend that it's going to pay divided by the book value. Both representative of the same period of time. Okay? Not as good as the market value, but if we don't have the market value information, it's better than nothing, right? Zach?
So to find the market value, would you just look at what their preferred stock is currently trading at?
Yeah, so the market value would be whatever it sells for in the market at this moment in time. Now sometimes we don't have a market value, and because many firms, privately held firms, their preferred stock doesn't trade in the market, right? So we wouldn't be able to use this. We would have to go to the next best, that which is okay. Best, okay, and I don't know what would be acceptable here. Okay? There just isn't anything else that I can think of. Okay? So preferred's pretty cut and dry. We can easily think about debt as having a cost because we pay interest, right? We can easily think about preferred stock as having a cost because we pay dividends based on the contractual obligation of the preferred stock. We have no choices. If we don't pay those things, the holders of them will say that we're in default and will take over our company. Okay? Can I say that same thing about common stock?
No.
I can't, can I? Because a dividend might be declared for common stock by the board of directors, and then it must be paid if it's been declared, but they may choose not to declare one. In fact, I'd say that the vast majority of private companies probably don't pay dividends. The majority of growth companies that are trying to reinvest all their capital inside the company because they're growing, because they're this fabulous new high-tech, fintech, internet, whatever thing, right? So they're growing ones. So since there's no necessary cost to the company, is there an opportunity cost that we can calculate? Francesca, that company that you founded 10 years ago, and you sold shares of stock to all of us in the room, do you owe us any money? Technically not. Now, frankly, the book value of the money we gave you, so the amount we gave you, is on the shareholder equity part of the balance sheet. It's on the right-hand side, but it's separate from the debt, isn't it? Yeah, it's equity. Okay. You don't owe it to us. In fact, the only way you could theoretically owe us anything other than the responsibility to manage the company for our benefit as stakeholders is if you declare a dividend and you said you're going to pay it. You declared it and then you're going to pay it. Okay? How could there possibly be a cost then associated with this?
For her or for us?
Well, we have to think about the cost for her is the same thing as the cost for us. It might be our return and it's her cost. We got to think about it in the same terms, but from different vantage points. Please, Zach.
So would you do, I mean, this sounds more like a book value way, but like at time of purchase to what it is currently at in that spread, so.
Sort of. Yes, you're on the right track. Think about this. If you had chosen, instead of raising $10 million in common stock from us, if you had chosen to borrow that money instead, you'd have owed $10 million plus whatever interest rate, right? And maybe you'd paid that off by now with retained earnings, etc. Okay. But you would have had all the equity stake in the company to yourself. So whatever you put in, the dollar, whatever it happened to be, you now would own the entirety of its value, right? Okay. So your opportunity cost is what you gave up in the way of returns when you sold some of that stock to us. And we know that we can credibly think about that because you didn't have to sell stock to us. You could have perhaps borrowed money in the open market. So that's the opportunity cost, right? Which what you said, Zach, is the nexus of that.
So whatever the amount of your common stock that's issued to what it's currently.
Yeah, it's growth in the interim. So whatever it's become worth minus what the original amount was, and maybe plus any dividends paid in the interim. Okay? That's the money. Now we equate that to a percentage rate, because when I say cost, cost is always expressed in percentage terms, or the decimal equivalent of it. So the ways that we're going to think about RE in its most beneficial form is by using the CAP-M equation. So the CAP-M equation for RE is equal to RF plus RM minus RF times beta. Do any of you remember CAP-M or the security market line from Finance 300? Little bits? Okay, good. There's hope. The security market line can be visualized graphically, where we have some measure of beta, and beta is simply a volatility index assigned to a stock by observing its variance from the mean price of that company's stock over a period of time. I'm not going to ask you to calculate it, okay? And you're probably happier now. I can tell Cole is. And some percentage return, okay? So on the x-axis is the beta value, on the y-axis is the percentage return, such that when the beta is 0, there's no volatility, and the percent return has a number to it. This then is the risk-free cost or rate of return. When a beta has no volatility, or the company has no volatility, no risk, if you get a return, that's the risk-free rate of return. Well, all companies I know of have risk. All companies I know of have risk. Okay? So that's not realistic. What doesn't have what doesn't have relative risk in the way of investments in our marketplace?
Bonds.
Well, some bonds do. I have this company, it's got a BB minus credit rating. I issue bonds, they have a risk. There's a contract that mitigates some of it, but it's still some, right?
Government bonds, though.
So maybe a treasury bond issued by the full faith and credit of the United States government, a T-bill, T-note, or T-bond. Why do we perceive those to have zero risk of getting our money back? Brigham?
Yes, there's still there could be a chance, but if the government's gonna go down and the concept that they can't pay you back, then everything's probably gonna be shot at that point.
Well, that's true, but there's something else. Sherry?
Because that is issued by the government for this.
Yes, but that's exactly what he said. Kara?
Just print more money.
Yeah. Any entity that prints its own currency has no excuse for not paying its bills. I can't afford it, I don't have the money in the bank, let me plug in the Xerox machine. Okay? So we know we're going to get paid back. Now what might be an issue is the value of the species that we get paid in. But that's a different issue. Okay? We know we're going to get paid back. Zero risk in that respect. Okay? So I use a 2-year treasury bond. I might be willing to use a 10-year treasury bond as a zero risk instrument. Could I reasonably use a certificate of deposit rate at a bank? What do you think? Ryan, could I reasonably use a CD rate at a bank?
Yes,
How come? I agree.
because they're locking in that rate for you.
Yeah, but so did a bond in that triple B minus company. Why else? If the bank fails, do the depositors get their money back?
So long as they're backed by the FDIC.
And all banks in this country today are backed by the FDIC. Now, the level of the deposit certainly goes up to $250,000 for the guarantee, might be an issue here. Yeah.
Just a question on the treasury notes. Were we factored in inflation at all with regard to risk of a treasury bond?
Good question. No. The discount rate that you're using probably has some measure, some input for inflation. So that's going to do it for you, okay, but not expressly. All right? So RF might be the interest rate I get on a 2-year or maybe even a 10-year treasury instrument or a 2-year CD. Okay. When a company has a beta factor of 1, what does that mean?
Risk factor.
Nicola?
I'm not 100% sure, but doesn't that mean that it moves exactly with the market?
Yes, I would give it different words, but it can be translated to mean the same thing. It's volatility and the reward that it's expected to give, because volatility, risk, and reward are connected at the hip, right? So it's volatility and the reward that's expected to give would be the average for the industry in which that company finds itself. So a beta factor is specific to a common stock in an industry, okay? My company will have a beta factor to it if I'm publicly traded, but I'm lumped together with all other companies in my industry to determine what the beta is. And the average volatility and reward in my industry receives a beta factor of 1, okay? Now if I have a beta factor of more than 1 for my company, that means my volatility is greater than. If I have one that's less than 1, my volatility, my risk, my reward should be expected to be less than that. Well, if this is the case, beta factor of 1 is connected to RM. RM stands for the average expected return for a common stock in that industry segment. Okay? And we expect that company with that average return to have a beta factor of 1.
You say RM's the average return for that, will you repeat that again?
The average return
Yeah,
on the stock for firms in that industry.
okay, perfect, thank you.
And if my company happens to also return that same percentage, I probably have a beta factor of 1, because if I return the average, I probably have an average volatility as well, all else being equal. Does that make sense? Okay. RF is the return we get for just putting our money into the market, period, right? We get RM minus RF for having invested in that industry. And we also get RF. When we interact RM minus RF, which is the yield premium we get for being in the industry, now we get a yield premium for investing in the company. Okay? So RM minus RF is the yield premium for the industry. RM minus RF times beta is the yield premium for the company. That yield premium for the company plus RF is the amount of return we got. This CAPM equation is, for RE, is the best version of RE we're going to find. Volatility, industry, comparative, it doesn't get any better. However, if a company's common stock isn't publicly traded, there is no known beta, right? Because remember, it's the market volatility of the common stock's price. And if it's not publicly traded, we don't have observable price, so we can't have an observable market volatility. It's the distribution or variance from its mean. So we don't have that information on all stocks. If I were to tell you that a stock has a risk-adjusted volatility factor that is 12% less than the average for its industry, a risk-adjusted volatility factor that is 12% less than the average for its industry, what beta would you want to assign to it? No, not negative, right? 0.88. Why? Because the industry is 1, 12% less than 1 is 88%. Okay? You may well see those words on a problem set and such, and those exact same numbers. Zach?
Can we talk about negative beta for a second? Because that means it just has a negative correlation to.
Yeah. So since you brought it up, yes, I would have brought it up myself. So a negative beta suggests that it is inversely correlated. Okay. It is possible for a negative beta to appear. You'll see in Google, Yahoo Finance, FactSet, Bloomberg, every once in a while you'll see negative betas. Negative betas should not be persistent, because if in fact it's accurate, the company's done, right? Okay. Or the company's just kind of in an interesting space. It's probably not a persistent measure. And we will not deal with it otherwise in this class. You might deal with it in other classes.
One follow-up. So if
Had to do it, didn't you, Scott? Okay, thanks, Brad.
so in terms of hedging, would a negative beta be something you want to look at, or is that?
Gosh, here's the beauty of working with me in these classes. You know that I've actually had a little bit of investment experience. I might have seen an investment once or twice in my life. I predominantly don't give investment advice or even make prognostications of that sort. Now, would I acquire a stock that had a negative beta factor? There isn't a poll long enough to get me to touch it, because I'm extraordinarily risk averse. Okay? Yeah.
If you have a dying industry with a business that's booming, then you can also have a negative beta, right?
You might as you're going to get the same financial outcome as shorting the stock. I wouldn't do that either. Me. I'm not giving you advice. Me. There's a contract in one of my files that when I got that contract, I also got a check that had a lot of zeros attached to it. You might suppose that one of the tenets of that contract is that I don't offer investment advice, and I never talk about the names or specifics of the companies that were invested in my private equity funds. So I love those zeros, as it turns out. Zero is something worth loving as long as it's preceded by lots of other things, right? Okay, so that's best. Okay, operates off of something that you'll remember very quickly. You know that P0 is equal to D1 divided by R minus G. That's the dividend growth and dividend yield equation. We talked about that earlier as we started. Well, this price is the price of the common stock, right? Because it's the common stock that pays a dividend that might grow. A preferred stock may pay a dividend, but it wouldn't grow, right? Preferred stock dividends rarely change. So this is a common stock from dividend, common stock price, the growth rate of the dividend. That means that this R must be the discount rate, the opportunity cost of investing in this common stock. And a couple of guys by the name of Modigliani and Miller, who created some theorems that won some Nobel Prizes, said this. They said that if that must be the rate for the common stock, which is RE, and if we reverse engineer this and solve for R, we get D1 divided by P0 plus G. That's not as good a measure for RE as the CAPM construction, because it's not as current, doesn't necessarily address all the components. But it'll do when we've got nothing else credible.
What if there's no dividend?
What if there's no dividend? Well, that's one of the reasons it'll do, but we don't love it. Because often there's no dividend, right? And if there's no dividend, what is RE?
G.
G. Well, that doesn't even necessarily make sense. Or it's extraordinarily optimistic, perhaps, right? It means that the company's rate of return is the growth rate in its retained earnings, and it must mean that it's investing those retained earnings optimally, which we'd love to believe that, but are all executives' decisions perfect? Not so much with that. Okay? So it's suboptimal, Zach, and that's exactly why. Similarly, the oh, will do, but I don't like it, could be RE being equal to simply the dividend at time 1 divided by P0. So the dividend paid for the common stock divided by the value of the common stock, which might be a book value in this case. If we've had to revert to the least acceptable RE, we're probably dealing with a book value of this common now. Okay? So best, okay, use it if you gotta, but only if you gotta. Okay? Those are the three inputs, aside from the weights and the tax rate, in the WACC equation. So if in a problem set, kind of like the one you've already got, that I'll give back to you, if you can identify E, either from a market or a book perspective, P and D, you can identify V. And if you've identified those, you've identified the percentage that each of those components represents of the whole. If you have information to identify RE, RP, RD, and if you know the tax rate on taxable income, then you know the weighted average cost of capital for the company. You can know this in a purely market basis if you have the inputs to have all the best R's, and if you've got market values for all the inputs. You can know it in a hybrid market and book if you don't have all of them, but you have some of them, or you can know it in a purely book basis, right? All of them are considered WACC. I will ask you to always use a purely market-driven WACC unless you're asked not to, or you simply don't have the information. Okay? Any questions about all of that? Clear as mud, right? It's actually not too bad. Although Scott's grinning at me again. Okay. Let's talk about G for a minute. I don't want to go too deeply into this, just in part because of time, but we got to give it something here. So generally, G, as we think about it, is going to be the long-run growth rate of the cash flow variable that we are assessing. Okay? Free cash flow, no plat, dividend, whatever it happens to be. So whatever cash flow variable is appearing in our equation, the G in that equation should be the long-run expected growth rate of that cash flow. Do we have any examples of corporations, companies, assets that have had long-run Gs? Remember, long-run means, in this deal, in perpetuity, forever.
Apple.
Do you like Apple?
Oh.
I think Apple's got a nice 10-year G, right? It's got a nice 20-year G. It may have a nice 30-year G. That's your argument, right?
Oh, yeah.
Yeah. Compare 30 years to forever for me for a minute.
Yeah, well, it, obviously, if it keeps growing at the size of, larger than the size of the economy, it eventually take over the world, so it's impossible.
It's exponential, right? It's impossible. We don't have any examples of any assets that have long-run Gs even approaching 10% well enough over them. And when I say long run, I mean forever. Because we might say Apple has some pretty impressive ones. There's lots of private companies out there that have some pretty impressive average growth rates for 10, 20, maybe even 30 years. But this G is going to appear in your equations in what I'm referring to as the continuation term or the terminal term, which you'll see is a forever term. So if we use a G that is very aggressive at all, we're suggesting that the company's value is going to grow exponentially in perpetuity. Pretty quickly it becomes the whole universe, right? So it's unrealistic. Yeah.
So would you always set it as close to what it would be the next like 5 to 10 years and then have it as a negative after that? Just to
No.
make sure that it doesn't go into infinity? Or at
No,
least
that's a
lower?
really good question. So what he's saying is, would you give it an unrealistically high number for a period of time, perhaps, what might be unrealistically high for a period of time, and then try to counteract that by giving it a negative? When you put that negative into its perpetuity, its terminal form, it's going to overcome the years of the positive. It creates a negative value. Okay, so you're in trouble when you do that. You'll see what we do though, I promise. What I would do is I would use a fairly nominal value. The expected rate of inflation long run for an economy, 2.5%. The expected growth rate of GDP for an economy in the long run, 2.5%, 3%. Okay? What is a really credible argument against that?
That it's the target, but we don't necessarily reach it.
Well, there might be some truth to that in isolation, but that's when we're applying that target to forever, it kind of gets out of hand, right?
It might be extremely conservative for the current period and the couple periods moving after.
Well, we know it's going to be conservative for some of the future and probably aggressive for some of the future, because if we use, let's say, 3%, are there going to be periods in which that company actually has less than a 3% growth? There are going to be periods of time where that company's begging for zero growth because it's experiencing negative, right? So yeah, there are going to be both sides of that coin. But there's something else. Francesca, you're capable, right?
Sure.
Yeah. Someday Francesca's name is going to be at the top of the mark, and she's going to be running a large corporation, probably a multinational, and you will have run this very well. We are your board of directors, by the way, and we're grateful to you. You've been compensated very handsomely for the last 10 years that you've had this position. Okay, and frankly, so have we, because we all own a lot of stock. If she's done really well at growing the company, having it profitable, did we get paid? Yeah, we got our director's fees, which might be substantial, and we got all the growth of our common stock. Thank you. And here's your gold watch, you're getting ready to retire, okay? And you're now responsible to help us find another CEO. Are you going to help us find a CEO? Are we going to accept a CEO that matches her expected performance, or, now it's an average performance over 10 years, we're not just looking at 1 year, or are we going to be willing to hire somebody with substandard to her performance?
Better.
If not better, at least as good, right, Cole? We're certainly not going to settle for less. Now, we might be wrong in our hiring decision, but when we're looking, we are going to find somebody that we think is going to carry on this legacy of growth, because we want to have to carry on for us our compensations, our returns as well. And we have enough money to pay them well, so we should expect great things from them. So we go ahead and find, and as it turns out, Nickel, you got the job.
Sweet.
Okay, that's paying her 7 figures, so it's some pretty nice options. Okay, so yeah, it's not too bad. She's living large. A year into your 10 years, because you're probably only going to be in the job 10, maybe 15 years, which again, drop in the bucket compared to eternity, right? In the first, second year of your 10 years, if you give us a performance that is meaningfully less than what she gave us, she was giving us an average of 12%, and you gave us 2. In a marketplace that was giving generally 5. What's your employment status tomorrow?
I'm fired.
Hey, you're unemployed. Okay? We're going to find somebody else. But as it turns out, you didn't do that. You gave us the performance. 10 years have gone by. We're in the same boat. We watch. We're all fat and happy. And it's time to find another CEO. We're going to repeat the exact same pattern, right? This time it's Kira that gets the job. Can we argue that we as a board of directors, or those who replace us, and these CEOs and presidents are going to continue this pattern? Well, we have every reason to believe they should. we are well enough heeled to compensate them extraordinarily well, so they have every motivation to do so. They're gonna do everything in their power. And we can say that trend is gonna continue on and on and on. Do those two things, using a very nominal 2.5%-ish lowball G, and believing that we can have a corporate record because of the great leadership that we'll bring into our company that will give us extraordinary returns, are those at conflict with each other? Is there friction? Sure there is. So I can argue for you guys in that scenario, and I can argue for the other. And consequently, I have very little hair left. Because as I told you guys the first day of class, G is my nemesis. It is the hardest thing we're going to deal with. Hardest thing to get our hands on in anything we're going to deal with. Oh, you might say it's very simple. We're just going to give it a low ball number. And that is safe and probably the prudent thing to do. But it's not necessarily the only thing to do. So G is the long run growth rate. You have on your corporate finance quick sheet where it says G is equal to investment rate times ROIC. Well, we know return on invested capital. It's no plat divided by invested capital. That's easy. That no plat and that invested capital come from a particular point in time, right? Well, what's investment rate? Investment rate is essentially equal to the percent change in invested capital. Now, there's an equation for it, and that equation is on your corporate finance quick sheet. But if you boil it down, it's essentially equal to the investment rate of your invested capital. It's got to do with net investments. Okay? Well, we interact these, we get a G. And this G is credible. You're going to find it in almost every finance book out there. Yeah.
So our investment rate on here is net investment for no plat.
Yeah, that's why I generalized it and said it's investment. It's essentially the change in invested capital. It's not specifically, but for our conversation, until you made it more complex, we were doing just fine. Okay. Remember, you're not that much taller than Garrett. Okay, a couple of us can take care of this. We have, right, Garrett? Yeah. Okay. So, and Garrett's sitting there saying, "Yeah, Ray, it's probably true as long as one of them's not." That's what Garrett says. So that's a G that we might think about. We might think about another G, which is the IGR. Who remembers the IGR from corporate finance? Does anybody remember even hearing the term IGR or internal growth rate from corporate finance? Remember what it is, Garrett? Okay. Its partner is the SGR. Internal growth rate, IGR, sustainable growth rate, SGR. The IGR is return on assets times B, not beta, divided by 1 minus the return on assets times B. B is equal to the net income of a company minus its dividends divided by the net income. Sometimes referred to as the retention rate. So net income minus that which we pay out in dividends or retained earnings divided by the net income is our B or our retention rate. Okay? When we take the return on assets, multiply it by our retention rate, and then divide it by the reciprocal or inverse of that value, we get the internal growth rate, or the growth rate that we think is possible when utilizing the company's assets, because it's built on return on assets. Return on assets is net income divided by total assets. All of this is on your corporate finance quick sheet. Okay? SGR is only marginally different. It's return on equity times B divided by 1 minus ROE times B. Now, I think in the problem set you currently have, you're expected to calculate these rates. And you've got all the inputs to do this. This shouldn't be all that challenging for you. Okay? And the equation's right there. In fact, I think it's even on the front page of the problem set, if I remember correctly. What's important to us in this discussion, though, is that these are all credible versions of a company's potential growth rate, aren't they? So which one are you going to use? one that talks about equity, the one that talks about assets, the one that talks about some investment rate, return on invested capital, this vanilla pudding one, this great one because of corporate legacy leadership one. What G are you going to use? Now you see why I don't have a lot of hair. That and 3 teenage daughters. Frankly, it's probably more to do with teenage daughters, to be honest with you. Okay? It's the nemesis. Oh, and by the way, if we have FCF is equal to no plat times 1 minus G divided by ROIC, and we not reverse engineer that equation and solve for G. That's another one. We could keep going. There's lots of ways to think about growth. The rules of finance are set in stone except for when they're not. You're going to have to figure out and know how to interpret when to use what and how to calculate G. It is the most mysterious of the inputs we're going to deal with. Typically in a problem set, I will give you express information as to what G should be in the long run. Okay? You shouldn't have to guess it, but at some point you're going to have to, and you're going to have to tell me why you guessed what you guessed and what your methodology was. It's good stuff, right? I dig this stuff. I really do. Mason thinks I'm a geek, and he's probably right, but I dig this stuff. Okay, any questions about any of this? I want to quickly go back to this. Remember that this valuation equation can be used if we believe we know what the next year's expected free cash flow is, and we believe that that cash flow is going to grow at a constant rate of G forever, in perpetuity. And we're going to use this discount rate, however we got that. Okay? This is a credible valuation form. We can know what the free cash flow is going to be next period. If we think that free cash flow is going to grow at a constant rate for forever, and we know what the discount rate is, we should be able to put together a value of that asset, because the present value of the future free cash flow is discounted for rate and time. But sometimes we might think we know this, but we know more than this. Do we possibly know the present value of the firm's discounted cash flow? That's not a complete equation. I'm going to take it in parts. Which present value of the discounted cash flow is equal to the sum of those cash flows? I'm going to say those cash flows are free cash flow at times I divided by 1 plus R to the T. And we believe we have the ability to forecast this with relative accuracy for a limited number of years. Could we come up with something that would give us this? Well, if I think I know what my firm's free cash flow is going to be next year, because I forecast my revenues, I forecast my expenses, I forecasted my capital needs, I can come up with a free cash flow, right? And I can do that credibly maybe for the next year, somewhat less credibly for the next year after that, yet less credibly for the next year after that, and pretty soon I am walking out on a limb that's about that thick, right? And I'm a little thicker than that, and you know that's going to end badly for me. But the first year, the second year, third year, maybe the fifth year, I can forecast my firm's cash flows with some credibility, depending upon what trajectory my firm has, what historical reality it has. If it's a brand new company, forget it. But if it's got a 70-year track record, I ought to be able to forecast the next 3, right? With relative accuracy. This is the explicit period. The period during which I can relatively accurately project my firm's cash flows based upon all my best information. But since the firm lives on, the asset lives on in perpetuity, I can't stop with this. So I have to take and add to that the present value of the continuing value. The continuing value is going to depend upon the model that we're using. Different types of models use a different form of continuing value. But let's say we're using the free cash flow model. And that's going to be free cash flow at time 1 divided by R minus G. Or it might be WACC minus G, because WACC is simply a form of R, right? So if I know the free cash flow for the year, or if I think I know the free cash flow for the year beyond my explicit forecast period, which means that it's going to have to still be relatively short to be even reasonably accurate, right? If I think I know the free cash flow beyond that period, I should be able to then use these values, my discount rate, some relatively nominal or otherwise growth rate, and I can come up with a number, can't I? But that number lives in the future. It lives after the explicit period. It is for my continuation period. Continuation, sometimes referred to as the terminal value or terminal period. And because it lives in the future, I have to take the present value of it. So I take the continuing value at its time 0, divided by 1 plus R to the t. That's how I discount it back to today. Present value of the discounted cash flow during the explicit period, or a period in which I think I can relatively accurately forecast free cash flows, plus the present value of the continuing value being the value that I ascribe based upon some long-run perpetuity-oriented explanations. Yeah?
And then you keep doing that, yeah, for
This
your time,
takes,
right?
this takes into account forever. Because when I use this form is an infinite series of values wrapped up into a very nice little algebraic package. So that's it. That's it. That's the free cash flow model, by the way. Okay? You're going to see that, and I'll expound on it a number of times, but I think these pieces of information will help you as you finish H through M in the problem set. Okay? Any questions? A lot of stuff, huh? And we're just getting started. We haven't gotten to the good stuff yet.